Get in Mihir Vora, Director and Chief Investment Officer at Max Life Insurance, joins us right now on the show. Mihir, we've been used to getting you in our office, so this seems a bit different, but nevertheless, times are such. Thanks so much for joining us today, nevertheless. What's your sense, Mihir? The economic impact of a move like the lockdown announced yesterday, and maybe possible further moves as well, is a bit of an unpredictable entity. How are you viewing investing in such a scenario?
Good morning, Neeraj. Yes, these are unique times. Frankly, it's very difficult to take any call at this point in time. The only thing that I can see that what we have seen in the last 1 week is that we haven't seen too many positions left in the market. So if I were to look at, say, the situation 10 days back, there was a lot of futures positions in the market as far as the FIs are concerned. But now, if I see the numbers, there are hardly any positions left in the market. So it's a very shallow market. The prices that we are seeing now are really based on very low volumes and created by liquidation of margin trades or we've heard some cases of ESOP funding, etc. So these are shares which are not being sold by rational analytical people like, say, fund managers or analysts, but these are basically sold because of financial needs or basically cash needs, so to say. So in this situation, given the way the lockdown is something that we've never heard of, never thought of, it's very difficult to take up any really good judgment on this, frankly. Obviously, there's going to be a recession globally. The June quarter numbers are going to be terrible. But I think the way the prices are there, probably, we'll have to bear the pain for some time, and hopefully there's limited downside.
So, Mihir, in your assessment, are the markets, I mean, even if they are up 2%, largely led by Reliance, a large bucket of stocks are still in the red. Do you reckon that the markets are pricing in some of the impact of an extended lockdown situation as well? Is it possible to kind of guesstimate that?
Very difficult, because this is not a situation where you can quantify the impact because there is the immediate loss of GDP, which is obviously going to be there since we are not doing any activity. And then there will be the secondary impacts in terms of job losses, bankruptcies, defaults. So it's very difficult to quantify the second and third order impact of this. It's for this reason that it's very imperative for the government to step in and also come out parallelly with a plan to save businesses and individuals, because just a lockdown is fine because we need to contain the epidemic. There doesn't seem to be any other solution, but it has to be mitigated by certain fiscal measures, and I hope the measures are coming sooner rather than later.
Mihir, just a couple of minutes that I want to spend time with you on. How do you think the market is looking at the banking space right now? One, fundamentally, and two, the kind of price damage that we're seeing on fairly limited volumes of selling as well. I mean, I was just surprised that the other day when we fell about 16-17% for the Nifty Bank, the cash market volumes were just about 33,000 crores. So it's not very high. So one, the fundamental gauge, and then the technical pressure, because almost everybody that I speak to seems to suggest that this is algo trading or algorithmic selling that is happening, which doesn't quite look at valuations, just places the sell order. How have you analyzed this?
So there are, in my view, 4 factors or maybe more, but let me just go through them one by one as far as banking is concerned. One is that algo trading angle is correct. You may see a lot of ETF liquidation because the market volatility has gone up. So a lot of these hedge funds and ETF linked exposures are linked to volatility. And when vol reduces, they increase exposure, which is what the situation has been for the past 1, 2, 3 years. We had a very benign market, very steady market going up with low volatility, which means that they were increasing exposure all the time. But in the last 3 weeks, we've seen gut-wrenching volatility, which means that they have no choice but to limit the vol and limit the exposure. So they have no choice but to cut exposure. So that's the reason why you are seeing a lot of probably ETF-based selling, because these are, they have a limited risk budget, and that risk budget is a function of volatility. Higher the volatility, lower the risk budget. So that's why they are liquidating stock. Second is, as far as banks are concerned, it was anyway one of the most popular segments to be in, especially the private sector financial space. It has a 40% weightage in the Nifty. So obviously, when you have liquidations towards India or redemptions in India, minimum 40% of sales will come in this segment. So obviously, there's a supply issue there. Third is that we also hear of certain cases in which a lot of ESOPs were issued to employees, and to fund the ESOP premiums, probably some of the employees had taken loans, leveraged loans, which also had the original probably shares as collateral. So with the share value going down, you need to top up. Make up the difference in cash or top up, which if you don't have, then the financier would liquidate the stock. So that's also something that we have seen in certain mid-cap names. And the fourth angle is that, that we just talked about. When you're talking about such a gut-wrenching economic slowdown, you are talking about second and third order derivatives in terms of business, small and big business bankruptcies, or stress, financial liquidity stress, and job losses. So not only are we likely to see stress in the corporate sector, but we may also begin to see stress in the retail sector because of job losses and lack of income for extended periods of time. So a lot of the retail-oriented NBFCs and banks, which were so far unaffected even by the corporate slowdown, are beginning to see those concerns being priced in.
I wonder, Mihir, the Aditya Puri con call, wherein he mentioned, he gave out statistics for his bank, of course, but that of the unsecured book as well, some of it is cards and some of it is given out to salaried people who are amongst the top corporates, and therefore they will not be hand to mouth. I think that was the implication drawn. The market doesn't seem to be making a distinction, or in that, of course, it is making some distinction, because the likes of IndusInd Bank, etc., are just continuing to be taken to the cleaners, whereas Bajaj Finance and HDFC have moved up a bit. But do you think that the price damage on some of the bluest of blue chip financial names is a bit overdone, or is it difficult to say? Because I would presume that if while the landscape has changed, for balance sheets to come out and do well, it would be some of these which would do that.
Absolutely. So when the economy turns, it's not a question of if, it's only a question of when the economy turns. These will be the same set of financials which will drive the market up because they still have a large weightage. But what we are seeing now is just liquidation based on money requirements, not based on any fundamentals or price or valuation, frankly. So it's just a question of temporary supply and demand in that particular stock at this point in time. So I don't think we should read too much into the prices. I don't think anybody's out there taking a rational call on whether the NPAs will spike from 0.5% to 2% or 3% or 1.5%. I don't think anybody's making those kind of calls. It's just that some funds or some individuals need money and they're selling.
Okay. I just want to take a moment and get Mihir's view on a chart that I want to lay out on our wall as well. This is a Bloomberg chart, and I'll just walk across because it shows what happened in the past template that we compare the current situation to. And this is the Asia companies profit estimates, of course. And watch this. This is as per the latest data available with Bloomberg, the cut in estimates, earnings estimates for the Asia Pacific region, about 13.4% thus far. From the time the meltdown started. Compare this to the earnings cuts that happened back in 2008 global financial crisis, about 58% or 59% annualized, but 58% for that period. Now, Mihir, my question is this. We let's assume for a moment's sake that we find a cure and the bad news around the pandemic goes away. But the bad news around earnings may not necessarily go away in a rush. If anything, for the next couple of quarters, we might keep on listening to that. Do you think that will keep the market under check? Or do you think the markets will discount that and think of the recovery 6 months out?
Sure. So our base case is that, the economy will go through a V-shaped recovery, probably in the September quarter or so, or maybe a little later. Because there is no choice for global and Indian government and central banks to basically, pull out all the stops, whether it's fiscal or monetary. I think we are a little bit behind the curve probably, but at some point in time we'll have no choice, and I think the markets and the economy will force the authorities to do that. So as and when that happens, you'll have a huge amount of inventory restocking, pent-up demand, etc. in a lot of segments. Probably the services segments is something that you can't have inventory for. But at least on the manufacturing side, there'll be a lot of pent-up demand, and we will see a V-shaped recovery. The rate at which the markets are falling, probably you might see the markets bottoming out a bit more before that.
Okay. Mihir, one last question. A lot of people that we've been talking to have been talking about whether they are with the cash that they had or the cash that they are getting. and what they are doing, whether they're starting to deploy 15%, 20%, 25%. Is there a sense that you can give about what your thought is? If you had cash, for example, and if you're getting new cash, what would your template be and why?
So we've been deploying on really bad days, like when the markets are in a real panicky. So we're putting a bit in, not going all out, I would say, but definitely looking at stock specific. Even the large caps. Some of the large caps are down 40, 50, 60%. So there is value out there being created. And we also must remember that the markets will bottom out at on a day. That will be the Nifty will bottom out on a particular day. Whether it's 1 week down the line, 1 month, or 2 months or 3 months down the line, we don't know that. But not all stocks will bottom out at the same time. So even when the Nifty has fallen, say 30%, there are stocks which have fallen 60, 70, 80% in some cases. And these are stocks which are going to survive, which are going to thrive when the economy turns around. So I think it may not be the best of ideas to wait for that particular day on which the Nifty bottoms out, but also keep an eye out for individual stock price movements.
Okay. Mihir, if I can ask you one final question, and you may choose not to answer it, but there's some interesting thoughts about how people's behaviors change after every large event. And one of the thoughts that was expressed was that people's behavior towards insurance might change a bit post this event, because people might start believing that it's very, very important to insure lives, have higher mediclaims, so on and so forth, etc. You are kind of associated, so I don't know if you want to respond to this or no, but purely as an investing mind, would you believe that the damage in the insurance companies provides with a chance to buy, because those businesses might anyways not get damaged too much, and post this is over, there might be a bit of a beeline to increase or take fresh insurance covers as well, both life and general?
A difficult one, frankly. It's not like insurance stocks haven't fallen. Even the insurance stocks have fallen in line with the rest of the private sector banks, etc. So I think the relative valuations still remain where they are. But having said that, probably there might be a bit of a rub-off once the lockdown is once the lockdown is lifted. There might be a bit more of interest than before, but difficult to speculate at this point in time.
Yeah, speculate. I think that's the right word. So if you indeed hear talks about that, maybe it is speculation right now, because it's very difficult to say with certainty. But Mihir Vora, take a moment to thank you for joining in today and giving us your thoughts. Stay safe.